Welcome to WakeCon, where we discuss housing economics and the economic forces shaping our communities. I'm Jordan Steffaniak, host of the WakeCon show, and it's powered by Professor Lending. We're based in Wake Forest, hence the Wake and the Econ together makes WakeCon. I'm your mortgage professor today, your licensed loan originator and president of Professor Lending, and I'm excited to share with you the second part of this masterclass on being a first-time home buyer. Though it's not just for first-time buyers, this is for everybody, because most people, they didn't get educated on these things. So if you watch the first one, now you're watching the second one. We're moving into how do you actually qualify for a mortgage? What does it look like? What does it take? What do lenders actually look at? So by the end of this video, you're going to know that. What do lenders look at? Why not all pre-approvals are equal? And how to qualify even with an imperfect credit score. Even with a 500 or lower, you can qualify given certain constraints. So what does that look like? The truth is, here's this little quote: most buyers disqualify themselves before they even talk to a lender. Don't be one of them. Come talk to me or somebody else who's a licensed loan originator who can actually strategically walk with you and understand, here is your whole picture. Here is what we need to do to fix you. Not fix you, but to fix this current situation to get you to where you need to go. Most people, they can qualify, but a lot of people, they can't for various reasons. 1, 2, 3, and we can diagnose and then tell you this is how we can get you on the road to home ownership. Don't sit renting for the next 10 years because you thought I can never buy a house. You can. There are ways to do it. You might need to be strategic and do this and that for the next 6 months, 3 months, 9 months, whatever it may be, to get you on the path to owning. So this is a masterclass. If you didn't know, we've got different episodes covering the topic of buying your first house. But again, it's not just for first-time buyers. So let's get started. What do lenders look for in a borrower? In times past, they look for 50% down payment, or look for a relationship that they existed where they were buddies, right? But since 1930s, 1940s, with the growth of different large lending programs and federal government subsidizing and backing all these mortgages, there's a whole lot more clarity in underwriting guidelines. And then you got in the 60s and 70s these consumer protection and equal opportunity acts that make sure that everybody has access to credit, and it's not just based on your good old boy network. So what do they look for now? Your debt to income ratio, that's important. So your debt to income ratio is your monthly debt divided by your gross monthly income. So we're not taking out taxes, we're not taking out your benefits, whatever else, or 401k, all that stuff. It's before all that's taken out. Now, the maximum DTI is going to vary by loan type. It could be well over 50%. You could be up to 55, 57%, actually. You can be more than that, depending on the loan product. Now, 45 is usually where you want to be at from a repayable perspective. If you go over 45, it's probably bad news for you. You probably don't want to do that from an ability to repay standpoint. Now, there may be certain circumstances where it makes sense to do it even if you're above 45, but just know it's comfortably, if you're below 45, you're safe. Now, if you do USDA, just so you know, loan product, it's got to be less than that. Okay, got to be 41. Okay, they're also looking for loan to value. Now, my cool little gold bar has disappeared. I don't know why. Loan to value, what are they looking for? Oh, let's go back. Oops. Yeah, look at that. Gold bar just disappeared like that. I guess I need to fix that. Anyway, they're looking for loan to value. That's the loan amount divided by your home value. The lower the LTV, the lower the risk. And if you're on a conventional loan, mortgage insurance is required if you're over 80. If you do FHA or USDA or those mortgage insurance is there for the life of the loan. VA, technically no monthly mortgage insurance, but there's a guarantee fee at the front, and that functions like mortgage insurance. But we'll chat about that later. So that matters. If you've got 80 LTV, 95 LTV, 60 LTV, that's going to be important for the underwriting process and for your pricing. Finally, the credit score, that's another very important thing that they're looking at. So depending on your loan product, that credit score is going to have more impact on your cost or provability than some others. Conventional, it's going to be very sensitive to it from a pricing perspective. For FHA, it's going to be less sensitive. Okay. So the credit score matters, debt to income matters, loan to value matters. Other stuff matters, no doubt. These are the three sort of key triumvirate triangle things you want to know. So let's talk about credit score briefly here. What determines your score? A lot of things. Number of new credit lines, your credit mix, types of loans, so installment loans versus credit cards versus student loans. So a lot of first-time home buyers, they don't have a good credit mix, and that hurts their credit. You need to have a credit card. You need to have 2 credit cards. Try to have a high balance on them, not a balance, credit limit on them, and try not to have a high balance on them. A lot of new buyers, they have these small cards with the small limits, $2,000 limit. So even if you just put groceries on it for a week and put something else, your credit amount owed is going to be skewed. It's going to be like 50% or 60%. You don't want that. You need to be below 30%. So just watch that and make sure to try to have a varied credit history because that's going to help your credit. Length of credit history matters, not as much as the rest, but the longer you had a credit card or an authorized user on somebody's credit card, the better. Now, authorized user on somebody who makes their payments on time and doesn't carry a large balance is important. Amount owed matters, so that's that sort of ratio. If you have a $2,000 limit and you have $1,000 that you used against it, 50% ratio, not good. You want to be below 30% usage. Then your payment history, making sure you make your payments on time is the most important factor. Don't be 30 days late. Don't be 60 days late. Definitely don't be 90 days late. That will kill your credit, and that stuff is not going to go away fast. If you're 90 days late on a payment, that's showing up in your credit report for 7 years. 7 years. Pay attention to everything that's tied to your name. Even if you have a student loan, your parents are supposed to pay it. Pay attention to it. Make sure they actually pay it. If they don't, it's going to nuke your credit. So please pay attention to those things. So you can pull your credit report for free at annualcreditreport.com. Now, this isn't a perfect mortgage credit report. All these sort of numbers and the way they crunch the algorithm can be a little bit different. So what you see on there is not going to be perfectly accurate for a mortgage, but it's going to be close. You also want to make sure, like that 30% utilization thing I mentioned here, keep it under 30%. That's going to make sure your score's good. Don't close old accounts. Another thing. The reason you don't close old accounts is because you need to show that you have a long history of making your payments. Do not listen to Dave Ramsey. Dave Ramsey, people come to me, the Dave Ramsey, sorry, Mike. Apparently it's late. It's 12:09 in the morning. Dave Ramsey people, they come to me. They don't have any credit cards. They don't have any installment debt. They don't have anything. Great. Your credit score sucks. And it's going to be difficult to qualify for a mortgage because the lender can't look at you and say, this person makes their payments because they have no history of making payments. Make sure you have actually credit cards or something else. And if your score is bad, we can talk about a rapid rescore. That's just a scenario where I pull your credit report and I see, oh, we've got some issues. But if we did this, this, and this, your score would go up by 30 points. That could be savings of thousands of dollars. And so we put together the strategy. You do that. We get official documentation from these creditors saying, yes, your balance is now this, or you did this, and we can rescore you and get a new credit score. It's amazing. You save a lot of people a lot of money. Happens. It's very important. Let's say you got a 699 score. Lenders and different people are scoring different tier buckets. So once you hit 700, you're getting better pricing. So it's worth it to do X. Let's pay this card by $500 down. I'm going to save $3,000, whatever it may be. It can be very much worth it, right? All right, let's talk about what is a pre-approval, because people ask me that all the time too when they're going out to buy a house. When do I need a pre-approval? What does it look like? Okay, pre-approvals are the lender's initial confirmation that you are going to be approved based on income, employment, overall credit. This is not a commitment to lend, and it's not a foolproof promise. Stuff can be uncovered later on in the process by an underwriter that would derail the whole thing. Somebody could make a mistake in their pre-approval too, and they forgot to calculate this or forgot about this unique guideline, and therefore we can't use this income or whatever it may be. That can happen too. Pre-approvals are not rock solid, but it's important to get a pre-approval from a trusted lender in the community or a trusted lender, period, that can give the seller confidence, because you need that when you go buy a house. You're going to put an offer in. You have to have a pre-approval letter, because if you don't, the seller is going to say, I don't even know this person can actually buy this house. Last thing I want to do is say, yes, let's do this, wait 30 days and find out that he can't actually buy it when I've got somebody else down the street who wanted to buy it and they're pre-approved. So pre-approval is super important for winning the offer. But it's also important to make sure you don't lose your earnest money deposit or your due diligence. And it's important to make sure that you actually buy the house. So you want a strong pre-approval from someone who's qualified and someone who can communicate and be clear on what exactly is necessary and needed. So what's pre-approval? Income, credit, liabilities, assets, right? So all they're really going to look at is they can do a soft pull if they need to. That doesn't impact your credit in any way, but it gives them access to all your liabilities. You're going to look at your income, pay stubs, tax returns if you're self-employed, W-2s, those sort of things. You're going to look at your credit, make sure that you don't have any derogatory accounts that might present a problem. You're going to look at your assets to make sure you actually have enough money to buy this house. And then they're going to provide just a document that says, hey, you're pre-approved up to this amount with this loan to value ratio. Now, what I do is I tailor the pre-approval to the specific house that somebody's putting an offer on. Like if it's $425,000 house, they may be able to afford $450,000. I'm still going to make the pre-approval $425,000 because I don't want the seller to think, oh, this person can actually qualify for more. I'm going to counter offer and give them a worse deal because I know that they can do it and they love this house. So strategically, it's important to have a lender who understands those sort of things and doesn't just willy-nilly give you whatever and then put you in a worse situation where you lose money. So lenders there's all sorts of important things about a lender, more than just people think about the rates. The only thing that matters in a lender. No. You got to have a whole strategic financial package to save you money to make sure you're in the best situation. Pre-approval, but also you need somebody just so you can actually get the house you want. So that's what a lender's really looking for in the pre-approval process, but also in the underwriting process, because there's a difference. Pre-approval is done pretty much by the loan originator on the front end. This isn't going to what's called an underwriter who has the whole 700-page manual memorized, right, on every little detail of the loan. And once they actually have all the documents in the picture, this is based on the limited upfront documentation you provide, which hopefully, in theory, a lender is giving you a pre-approval based on actually looking at the documents. But we're talking about loan originators. They may not always do that. Hopefully they do. That's why it's important to have a good lender. But they're going to look at this. They're going to give you this agreement to say, yes, you're pre-approved, subject to all these things. Because there's other stuff that could come up. It could be not you. It could be the property. There could be a bunch of liens on the property that no one knew about. And there's nothing you can do about that. So you want to make sure you're pre-approved, though, from a solid lender who can communicate that to the listing agent as well. If the listing agent knows and trusts them, or has them call and reach out proactively and say, my buyer is well qualified, rock solid, and all these ways, use this. For example, I have a client who won an offer against 8 other offers because I called and communicated to the listing agent, my buyer is rock solid, will be fast, we'll get this done in less than 2 weeks. We will do this in a way that is smooth, efficient, fast, and there will be no hiccups. Because I did that, they were able to beat out 8 other offers. So it's important to have a good lender who can give you a strong pre-approval. But also, that credit advice, the loan to value, debt to income, all these things matter. But it's important just to have a strategic partner by your side who can help you walk you through these sort of things. Anyway, this is episode 2 of 5 in a masterclass on buying a house. And I look forward to you guys checking out the future installments or previous installments.